there a perfect long-term care insurance policy? Well, here to talk with me about that is Scott Olson from the LTC shop. Scott, welcome.
Thanks, Bob. It's a pleasure to be here.
Pleasure to have you here. You recently wrote an article about this very topic for Retirement Daily. We're eager to have you walk us through what you wrote.
Okay, great. Yeah. Obviously, there's no such thing as a perfect long-term insurance policy or a perfect long-term care insurance policy, but there have been huge improvements made to long-term care insurance over the last, decades. And just like, what hasn't improved in the last 30 years, right? Looking at the old long-term care insurance policy, it's kind of like that big giant cell phone that they had in the movie Wall Street, right? Well, that's what those older policies look like in my eyes, okay? And compared to the newer policies that are awesome, we got the newer policies are like smartphones, right? So, but the one of the biggest changes that happened to long-term care insurance was in 2004. President Bush signed a law called the Deficit Reduction Act, and part of that law created or allowed all 50 states to create what's called long-term care partnership programs. And they're called partnership programs because they're a partnership between the federal government, state governments, insurance companies, specially trained insurance agents, and consumers. Okay, and normally, if someone's going to rely on, for example, most people who need long-term care, it's funded through Medicaid, right? Not Medicare. It's funded through Medicaid. So they have to spend down their assets before they can qualify for the government-funded care. So the Deficit Reduction Act created these long-term care partnership programs, which changed the rules. Okay, so instead of having to spend down my assets in order for Medicaid to pay for my care, if I have one of these special long-term care partnership policies, I can protect some, maybe most, possibly all of my assets, depending upon how the policy was set up and how much care I might need. So for instance, the most common way that these programs are set up is that for every dollar that someone receives in benefits from their long-term care policy, they can protect $1 from Medicaid. Okay? So for example, if I've got a long-term care policy that pays out $1 million worth of benefits, and they're out there, it's possible. Okay, some of my clients have received almost that much from their policies. But if I got a policy that pays out $1 million worth of benefits, I can apply for Medicaid, and then Medicaid will allow me to keep $1 million worth of assets. So it's these programs are very special. They solve the problem, or they answer the question of, well, what if my policy runs out of benefits? Then I'm just going to have to use my own money anyway. Well, not so much so with these partnership programs. You don't have to spend down all your money, and you can protect your money even if the policy runs out of benefits.
So, relative to standalone and long-term care insurance policy, is it similar in many regards in terms of premiums or wait periods or inflation riders?
Great question. Right. These long-term care partnership programs are standalone long-term care insurance policies, okay, what I call traditional long-term care insurance, okay, and one of the requirements in these partnership policies is that they have to have inflation protection, okay, and how much inflation protection they have to have depends on two things. It depends upon the age that the person is when they purchase the policy, and they depend upon the rules that particular state has. Okay, so every state has slightly different rules for the partnership program. There's 45 states that have these programs. Four of the states that kind of defunct, but so there's 41 states that have functioning long-term care partnership programs. And some of them say, well, if you have just 1% compound, that's enough to qualify for the partnership program. Most states say if you have to have at least 3% compound inflation protection in order for the policy to qualify for this special asset protection. Okay? And so, and again, it all depends upon how old you are when you buy the policy. The younger you are, the higher the inflation protection needs to be.
And the insurer is a typical insurance company that someone would buy a long-term care policy from?
Yeah, exactly. Yeah. I mean, it's exact same insurance companies that sell the traditional policies also sell the partnership policies. And basically, it is a traditional policy, but it just happens to have the, a stamp of approval saying this meets all the requirements of our state's partnership program. So, they're identical. I mean, if, for example, I applied for a policy that's a partnership policy and it's got 3% compound. If in the future I removed that 3% compound, in most states, the policy would lose its status as a partnership policy. Okay, so if that makes sense.
Yeah, no, and it's worth noting that when you have a 3% or a 5% inflation adjustment, the premium could be a little bit higher than had you not had that inflation adjustment.
Absolutely, absolutely. So, if somebody wants to lower their premium or have a more cost-effective policy, I typically recommend keep the 3% compound, just lower the daily benefit or shorten the benefit period, or lengthen the elimination period. That's always a good way to save some money too. Yeah.
So as is my one, I asked ChatGPT about long-term care insurance partnership plans and asked for features and benefits and drawbacks. Among the features, extended coverage period, customized plans, premium stability, investment component, riders and add-ons, and guaranteed renewability. Any thoughts about any of those?
Well, yeah, a policy that for a policy to be a partnership qualified policy, first off, it cannot have any type of life insurance or annuity component. Those are not partnership qualified. But they are traditional long-term care insurance policies, and they have to meet the federal guidelines for long-term care insurance. Most people don't know that the federal government created consumer protections for long-term care insurance in 1996. Okay, when HIPAA was passed. Okay, the included in HIPAA was 12 pages that essentially created these special consumer protections for long-term care insurance. And the federal government said, if an insurance company creates a policy that has these consumer protections, then we will grant tax qualified status. And tax qualified status means that the policy would have tax deductible premiums, and in 99 times out of 100 tax-free benefits. Okay, there's a handful of policies that might have some taxable benefits, but they're very, very rare. Okay, so essentially tax deductible premiums and tax-free benefits, which is unique for any type of insurance. The only two types of insurance that have tax deductible premiums and tax-free benefits are medical insurance and long-term care insurance. Nothing else, just those two. And with disability insurance, if you deduct the premium, you're going to pay tax on the benefits. Okay, but not with long-term care. You can deduct the premium and still get tax-free benefits. So this is a long answer to your short question. So in terms of since the policy has to meet the federal guidelines, one of the federal guidelines is guaranteed renewability. Okay. So the policy, the insurance company has to renew the policy every year as long as you pay your premium on time. Okay. So so that's important, because you can't have a policy that's going to be canceled when you turn 80 and you find out that they're not going to insure me anymore. No, it's too late. So the policies have to be guaranteed renewable.
Follow-up question on that. With typical standalone coverage, the insurance company might be applying to the state insurance department to increase the premiums on a certain class of policyholders. Is that the same true for these plans?
Yes, it is. Okay. And fortunately, 41 states now have what's called the rate stability regulation. And most people have not heard of this. Most insurance agents haven't heard of it. Okay. But it's really cool. It's one of the few things that it's a special type of pricing rules that was created just for long-term care insurance. There's no other insurance that has pricing regulations like this. And 41 states have passed this regulation, which is good. Okay. And basically the regulation did a couple of things that are really good. It it removed the profit incentive from rate increases. So everybody thinks, well, if the insurance company is going to raise the rates, well, they're going to make more money. No, not if the policy's under the rate stability regulation. And like I said, there's 41 states that have it. You can go to my website if you want to take a look at. There's a map that shows the states that have it. 9 states don't have it, and there's a couple states that it's a piece of cake for an insurance company to get a rate increase, okay, because they don't have that regulation. But so this regulation removes the profit incentive. They have to, if they request a rate increase, they are required to lower their profits and reallocate some of that profit into claims. Okay, and then the actual rate increase itself, so that extra premium that that's having to be paid, they don't even have regular profit levels priced into that. They have a small amount priced in for administrative expenses, but everything else in that rate increase is going towards claims. So what's happened is, I mean, the rate stability regulation was created in the year 2000, believe it or not, while we were waiting to find out who was going to be president. Okay, remember that? Okay, so that's when it was created. But like all insurance laws, they have to be adopted one state at a time in the state's legislature. So 41 states have adopted that program. And it's working. Okay, so for one of the other aspects of the rate stability regulation is that it requires insurance companies to, if they're going to sell a policy today, they have to include all the prior rate increases in today's pricing. Okay, which is really interesting. So in other words, so let's suppose I'm buying a policy from XYZ company today, and that company had an 80% rate increase 5 years ago. Okay. Well, if I buy that policy today, I'm not going to get hit with that 80% rate increase because that 80% rate increase is already priced into my policy. So the bad news is that the long-term care insurance policies available for sale today are the most expensive policies that have ever been sold. The good news is the long-term care insurance policies available for sale today are the most expensive policies ever sold. Okay? The bad news and the good news are the same thing, okay? Yeah, they're expensive. They're, freaking expensive. Am I allowed to say freaking? They are freaking expensive. But that's why it's important to shop around, okay, and find value, okay? But they are expensive, but they're expensive because they're designed to be price stable, okay? And any policy sold today in a state that has the rate stability regulation, an qualified actuary has to certify that there are no anticipated increases for that policy forever. Doesn't mean it couldn't have a rate increase, but they do not expect it for these newer policies.
Yeah. So some people might view a higher premium like that as a disadvantage or a negative. Are there other disadvantages that you can identify with these long-term care partnership plans?
Well, because they're traditional policies, the other disadvantage is just that is the underwriting. I mean, you've got to be pretty darn healthy to qualify for a long-term care policy today, a standalone, long-term care policy, whether it's traditional or a partnership program. I mean, that's just the reality of the situation. I mean, the insurance companies are very cautious about what risks they take. The biggest mistakes consumers make is delaying buying a policy, and the best advice I can give anyone is apply for a policy when you feel like you're too young and too healthy to be buying it. Okay, that's exactly how you should feel. I'm too darn healthy to buy this. That's right, you are. That's the time to buy it. I'm too young to be buying long-term care insurance. That's right, you are. Okay, the time to buy it is when you've got enough money to protect to justify the premium. Okay, and so anyway, so go ahead. Yeah.
No. So, and then I think in terms of there are all these at times horror stories of people having a long-term care insurance plan and applying for their benefits and being denied or having hassles over getting the benefit that they want.
Yeah, great point. And I myself did not file the claim for my mother-in-law when she needed to use her policy. I didn't do it. Okay, I could have. I mean, I kind of know what the companies are looking for. I should know, right? So I have a good feeling of what they need to do. But I didn't want to do it. We actually farmed it out to the home care agency that was doing it. A lot of the big national chains, the big home care agency franchises that are nationwide, they have a whole system for processing long-term care insurance claims. Just like when you go to your own doctor, I mean, when you go to the doctor, you don't pay the bill and say, okay, I'm going to go file the claim now. Okay. No, your doctor's office files the claim. Your doctor has a claims specialist who's got it all. It does nothing but that. Okay. Same thing with long-term care insurance. I mean, the best advice I can give somebody is don't try to do it on your own or don't have your son or daughter or somebody else try to do it. Even if they're a doctor or a nurse, they don't know. They don't necessarily understand the insurance, and if you don't understand the difference between an elimination period and a certification period, then you should not be handling a claim for long-term care insurance. Okay. And because it's one of the biggest confusions is that it's like, well, if I go into an assisted living facility, then the policy will pay the benefits. Well, not necessarily. Okay. It's going to depend. What do you need help with 2 of the 6 activities of daily living? Well, then it'll be able to pay for your time in the assisted living facility. But just moving into a facility is not gonna cause the claim to be paid.
Yes. Scott, we covered a lot of ground in 15, 16 minutes. Anything we missed or anything that bears reemphasizing?
Just there's about 41 states right now that have functioning partnership programs that have good policies with reasonable premiums. There's 4 states that have these programs that their current rules have basically driven out the insurance companies. They just don't want to sell those products anymore. So in New York, California, Indiana, and Connecticut, you can't buy a partnership policy today. But in 41 other states you can. Now, Massachusetts is unique, okay, in that, Massachusetts says that if someone buys a policy that has 2 years of benefits, that the Mass Health, which is, Medicaid in Massachusetts, will change the rules for them and will not put a lien on their home. So, it doesn't protect any other assets, okay, but the other states protect all assets, not just a residence, okay. And the other cool thing about the other states that have the partnership program is not only does it protect assets now while you're alive and applying for Medicaid, but it also protects assets after you pass away. Because the federal government requires states to do a state recovery. Okay, so after somebody dies, if they relied on Medicaid, well, then the state's governments can go in and look at say, okay, well, that asset's now ours, or you owe us this much, your estate owes us this much. Well, the long-term care partnership programs protect assets even from the estate recovery process. So that's special too. So.
All right. So one last question: who would someone go to buy such a policy? A typical long-term care insurance agent like yourself?
Yes. Yeah. If you're going to buy long-term care insurance, you really should speak with a specialist, somebody who specializes in long-term care insurance, like me. Okay. I've been doing it since 1995, just long-term care insurance, nothing else. So, definitely do that. I found that when people go to an investment advisor to ask them about long-term care, 9 times out of 10, they're going to be given a quote for cash value life insurance, and which is fine. I mean, that's one way to do it. Okay. But there's some of those products are not so good. Okay. All right. But usually the most cost-effective way to protect your assets from long-term care expenses is with a traditional long-term care insurance policy, especially a long-term care partnership policy.
Yeah. Well, maybe in a future video, Scott, we could talk about sort of the specifics of the elimination period, the certification period, et cetera, et cetera, et cetera, because I think it
Sure.
would be fun to do a deep dive on that.
I'd love it. I'd love it, Bob. Absolutely.